Welcome to the Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to the Weekly Option. This is episode 359 on January the 24th, 2025. I'm your host, Eric, and in this week's show, we'll cover the trades from last week on Cleanspark Inc., Barrick Gold Corporation, and the United States Steel Corporation. And we discuss three new trades on SoundHound AI, Iris Energy, and Bank of America. Now, it's always great to hear from listeners. If you have any questions about the trades presented here on the show or even about your own positions, feel free to email me. You can email questions to eric@theweeklyoption.com. That's ERIC@theweeklyoption.com. I've also created a few videos to teach you all the basics of option trading that you'll need to know to be able to follow along with me on this show. You can visit our website and click on the videos tab to watch them, or visit the YouTube channel for the Weekly Option. Now, the market finished the week higher for a second week in a row. The Dow Jones Industrial Average picked up 936 points, closing at 44,424 points. The S&P 500 index grew 104 points, ending the week at 6,101 points. Now it's time for the topic of the week. The topic of the week is strong opinions loosely held. I can't find the original source of that quote, but it is a key part of my approach to the markets. I want to have strong opinions, ideally backed by data and research. However, I know that the market does not have to move in the direction that my analysis expected. In fact, it was John Maynard Keynes, the founder of demand-side economics, who said the market can stay irrational longer than you can stay solvent. You do not want to have a strong opinion that makes rational sense, but costs you money. That brings up the second part of the quote, loosely held. It is important for me to always remember to adjust my trades and my understanding of the market to the outcomes of the market rather than my expectation of the outcomes of the market. You could have the right trade on in the wrong market. You could own a call option in the 1 month of the year when the stock price goes lower. It was the right trade at the wrong time. In that scenario, your strong opinion about the forecast of the stock price was correct, but your trade was wrong for that month. You will need to make an adjustment to limit loss or try to create a profit. So if I were to alter that quote, I would say have strong data-supported opinions that are loosely held and open to adjustment as more data comes. If you and the market are going in opposite directions, it's not the market that is wrong. Don't ever let your ego get in the way. Take another look at what's going on in the market and adjust accordingly. So that's it for the topic of the week. Let's go ahead and get into the review of last week's trades. So we'll start off with our covered call on Cleanspark Inc., symbol C as in Charlie, L as in Lima, S as in Sierra, K as in Kilo. At the time, the stock was trading for $11.87 per share. I looked at buying stock and selling the February 12 call at $1.45, hoping for a return of 13.31% in 5 weeks. Well, shares of Cleanspark fell 34 cents, ending the week at $11.53 per share. The call option that we sold lost 39 cents, which leaves us with a net profit of 5 cents if we were to close the trade out immediately. Now, we are still more than $1 above our break-even point, so no adjustments are needed at this point. Even with the drop in the stock price, we were protected by the loss of value in the call option that we sold. Now, you'll definitely want to track the stock over the next 4 weeks and have a game plan just in case you need to make an adjustment. Next up, we have our credit spread on Barrick Gold Corporation, symbol G as in Golf, O as in Oscar, L as in Lima, D as in Delta. At the time, the stock was trading for $16.01 per share. I looked at selling the February 16-15 put spread at 33 cents. That could give us a maximum possible loss of 67 cents per spread. Well, shares of Barrick Gold grew 14 cents, closing at $16.15 per share on Friday. The out-of-the-money put spread that we sold is still out of the money, and even if the stock continues to creep higher slowly, we'll be happy. In fact, slow stock movement implies lower volatility, which will also lower the value of this spread. Now we want the spread to slowly creep towards zero. If the stock continues to increase, this trade will work out. So far so good. No adjustments are needed on this trade at the moment either. Definitely keep track of the stock price and the break-even price to decide if you need to make any adjustments over the next 4 weeks. Next up, and finally, we have the debit spread on United States Steel Corporation, symbol X as in X-ray. At the time the stock was trading for $36.04 per share, I looked at buying the February 35-36 call spread for 62 cents. That could give us a maximum gain of 38 cents, or that's a 61.29% return in 5 weeks. Well, shares of the United States Steel Corporation grew $1.36, ending the week at $34.40 per share. That in-the-money call spread that we bought is now even more in the money. That means the spread is increasing in value and making us money, which is great. With the stock price nearly $2 above our break-even point, this trade is working out just as planned, so no adjustments are needed on this trade at this point either. So that's it for the review of last week's trades. Just as a reminder, all trades on this week's show will use the February 21st expiration date for monthly options in the month of February. So let's dive into the new trades for this upcoming week. We're going to start off with a covered call on SoundHound AI, symbol S as in Sierra, O as in Oscar, U as in Uniform, N as in November. The stock ended the week at $15.84 per share. I'm looking at buying stock and selling the February 16 call at $1.90, hoping for a return of 13% in 4 weeks. And you enter this trade by buying stock for $15.84 per share and selling the February 16 call at $1.90. This trade makes the most money if stock prices finish above $16 per share. The break-even price is $13.94 per share. In real terms, that stock purchase will require $1,584, and you'll collect $190 just for selling the option. Next up, we have a credit spread on Iris Energy, symbol I as in India, R as in Romeo, E as in Echo, N as in November. Stock ended the week at $13.32 per share. I'm looking at selling the February 13 12-half put spread at 17 cents. That could give us a maximum possible loss of 33 cents per spread. Now you enter this trade by selling the February 13 put at $1.19 and concurrently buying the February 12 half put for $1.02. This is a credit spread because we are selling the spread, and this trade makes the most money if stock prices expire above $13 per share. The break-even price on this trade is $12.83 per share. In real terms, you'll receive $17 per spread that you sell and have $33 at risk. And then our final trade on the week is going to be a debit spread on Bank of America, symbol B as in Bravo, A as in Alpha, C as in Charlie. The stock ended the week at $46.51 per share. I'm looking at buying the February 46 half call spread for 32 cents. That could give us a maximum gain of 18 cents or a 56.25% return in 4 weeks. Now you enter this trade by buying the February 46 call for $1.44 and concurrently selling the February 46 half call at $1.12. This is a debit spread because we're buying the spread, and this trade makes the most money if stock prices expire above $46.50 per share. The break-even price on this trade is $46.32 per share. In real terms, you'll pay $32 to enter the spread, and your maximum gain is $18 per spread. Thanks so much for listening to this week's show. Hope you have a fantastic weekend, and as always, happy trading. Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer: there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website